In this video, I'm going to go through our Accounting 1, Chapter 2, Work Together Problems. So this is Chapter 2, Lesson 1. We are introduced to T accounts, and for these T accounts, we need to label our debit and credit sides of each one. So we'll go ahead and do that. Debit's always on the left, credit's always on the right. And if you don't want to type the entire thing out, I'll also accept DR for debit and CR for credit, like that. Okay, next thing, move an up arrow on the increase side, move a down arrow on the decrease side, and label your normal balance. Okay, so cash has been done for us, normal debit balance. Increases with the debit, decreases with the credit. Accounts payable, so your supplies. That is a liability account, so it will increase with the credit and it will decrease with the debit. Normal balance will be on your credit side. Whatever your increase side is always going to be your normal balance side. Okay, so accounts receivable, Sullivan Company. That is an asset, so it will increase with the debit, decrease with the credit, and our normal balance will be on the debit side. Accounts payable, Oceanside Supplies, that's a liability, increases with the credit, decreases with a debit, and normal credit balance. Supplies, that's an asset, so it will increase with the debit, decrease with the credit. Normal balance, debit side, where it increases. Parker Vogel Capital, that's going to be a credit balance. It's your owner's equity, so it will increase with the credit, decrease with the debit, normal credit balance. And our last one, prepaid insurance. It's going to be a normal debit balance, so we'll increase on the debit side, we'll decrease on the credit side, and our normal balance will be over here underneath debit. We can't get this other text box to go away. But we won't worry about that. Next one. 2-2 work together. This time we're going to take it just a step further and you'll be identifying which accounts here listed are used on each transaction and then filling in the T account. So the first one, March 1st, received cash from owner as an investment, $4,000. The two accounts that we need to know, we might have to send this to the back. Okay. The first one is received cash, so we know we have cash from the owner as an investment. So John Gentene Capital will be our other account used. So if we received cash, it goes up. Debit's here, credit's here, and it will be a $4,000 debit. From capital, so that will be a $4,000 credit to increase the capital. March 3rd, paid cash for supplies, $95. So our two accounts used, cash and supplies. Again, the left side is always the debit, the right side is the credit. So we'll go ahead and fill those in for all of our accounts. And in this particular one, we paid cash for supplies, $95. So our cash goes down with the credit by $95. Our supplies goes up with a debit by $95. And remember, our debit must always equal our credit for each entry. So we must always have a credit and a debit. Okay, March 4th, bought supplies on account from Supply Depot, $120. So our two accounts are supplies. And how about accounts payable, where A/P will do Supply Depot. So if we got supplies, those will increase, and that's $120 for a debit. And accounts payable will also increase because we owe them money at some point, and that increases with the credit. March 6th, paid cash for insurance, $250. So cash is one of our accounts, and prepaid insurance will be the other. And if we paid cash, well, we know it's going to be a credit. And prepaid insurance is another asset, and it will increase with a debit of $250. And the last one, March 9th, paid cash on account to Supply Depot. Cash and accounts payable, Supply Depot are two accounts. So up here, we bought supplies on account at Supply Depot, and now we're paying down our balance at Supply Depot. We're only paying them $80 though, and we know up here we owed them at least $120. So we would still owe them some money. All right, that is the end of Work Together 2-2. Not too complicated. It looks scary, but it's not. Let's do 2-3. Very similar to 2-2, but just a few more accounts to think about. So, your first one, March 11th, sold services on account to Johannes Eriksson, $125. This is the first time we've seen sales, but when we hear the word sold service, we know that we're going to use a sales account. And then Johannes Eriksson. If we look back one slide, we can see all of our choices. This one's going to be accounts receivable, Johannes Eriksson. So we'll type that in here. You can use A/R to make it fit if you'd like to. Sales increases with a credit. So we can fill out our debit and credit sides, and it will be $125 credit to sales, and it's going to be a debit to this accounts receivable, right, because that's an asset, so it will increase with a debit. Johannes Eriksson. She owes us $125 at some point. March 13th. Received cash from sales, $260. When we hear the word cash, we know that that's going to be one of our accounts. And we received cash from sales is going to be our other. We'll label our debit and credit sides because it's just a good idea, so we always remember them. Received cash from sales, $260. We know it's a debit to cash to make it go up, and a credit to sales, which also it increases the sales. Other side of the equal sign, and our assets equals liabilities plus owner's equity. Remember, sales is over there underneath that umbrella of owner's equity. It increases with a credit. Okay, next one. March 14th. Paid cash on telephone bill. The first thing we know is that it's cash because it says paid cash, so cash will be credited. But what's our other account going to be? We paid the telephone bill. If we look back at the last slide, we can see our choices, and I would say it's going to be utilities expense. Sometimes you see telephone expense used or communications expense, but this time I would say it's got to be utilities expense. So we'll type that in as our other ones. There. We'll label our debit and credit sides of our T accounts with DRs and CRs. So if we paid cash, we know that's a credit of $54, and our utilities expense will increase with a debit. It's very rare that your expense would have a credit until the end of a period. So you're almost always going to be debiting an expense. March 16th. Received cash on account from Johannes Eriksson, $125. If we receive cash, we know that's one of our two T accounts. And our other one is from Johannes Eriksson. And remember, it's up here that we sold services to her. So it's going to be that same account. Accounts receivable, or A/R, Johannes Eriksson. We'll label our debit and credit sides. And we received cash, so cash will be debited, $125. And we will credit the accounts receivable, Johannes Eriksson. That actually brings that balance down. In fact, it looks like it probably pays off that March 11th charge she made. And so this is just transferring one asset for another. The accounts receivable goes down, the cash goes up. All right, last one, March 19th, paid cash to owner for withdrawal of equity, $200. We know we paid cash, so we'll go ahead and write that one in on our first T account. And our other one is going to be our owner, comma, drawing, which our owner's name back on the previous slide is John Gentene, comma, drawing. And this is basically like John Gentene giving himself a paycheck from his sole proprietorship business, right? He owns Gentene Cleaning Services. Eventually, he needed some money for personal use. He drew some out. That's what this entry is. So March the 19th, he took $200. Oh, so we'll put that down here underneath the credit on cash. And then we will debit John Gentene drawing $200. The drawing account's kind of like an expense account where it's almost always going to be debited. There will rarely be a credit until an end of the period closing. So there's your entries. T accounts in Chapter 2. All 3 lessons here in this video. Good luck.